HSBC says it's comeback season for U.S. exceptionalism, with short-term sentiment and positioning making this a tempting entry point for risk assets, especially U.S. equities. Joining us now, the analyst behind that call, HSBC Chief Multi-Asset Strategist Max Kettner. Max, so you don't see a recession here, and you believe investors should be essentially piling into risk assets, including U.S. equities, high-yield credit, and even some EM debt?
Yeah, look, and thanks for having me. I guess, we've been pretty bullish since the start of the year, and we've been sort of really increasing that bullishness throughout really the last 8-9 months. And, particularly when it comes to what happened in August, I think a lot of focus was around, obviously, the increased treasury supply was on, the higher yields, particularly at the front end. And all of that really led to that sort of broad-based sell-off across the asset classes. We kind of called it's a whiff of 2022, right? It's a little bit of like, okay, there's nowhere to hide apart really from cash and US dollar cash. So it was a bit of a whiff of 2022. But the real difference this time around is that a year ago, we all thought, okay, this can only end in a hard landing. All of this tightening has to end badly, right? Whereas this time around, I think, when we look at the Atlanta Fed GDP now index, or if we look at indeed consensus expectations, right, for Q3 and Q4, they're just being relentlessly upgraded right now. So the picture is very different from last year. Last year, it was broad-based weakness because also there was concerns around earnings, concerns about growth. This time around, it's actually strength, right, and real strength, particularly in the U.S. economy, that's prompting us to really say, okay, it's time to jump back in.
Max, it's interesting, dollar index close to 104. I wonder if you think we return to the days where, you're closer to 114, where dollar strength is actually a symptom of severe global market stress.
No, because we don't really foresee that kind of market stress, right? So in order to get to those sort of 114 that you just mentioned, we would really need to have a proper sort of stress event in markets, right? Some sort of default, so, something like we've had in March, for example. So really a big sell-off, again, across the asset classes. The fact really is now, even with the little bit of an increase, a little bit of a strengthening in the dollar that we've seen over the last couple of weeks, the dollar, the trade-weighted dollar, and the DXY are significantly down on a year-over-year basis, right, when we compare it to the high of last September, last October. What that means is that now in Q3 and in Q4, the S&P, which still generates around 40% of its revenues from foreign sources, it actually will get quite a nice boost from that weaker dollar compared to last year. And we're just entering that, right? It's really a picture of Q3 and Q4. Might be different again in Q1, but now we're actually really entering that period where the weaker dollar compared to a year ago will, in fact, help dollar earnings and U.S. earnings in particular.